It's been very, very rapid indeed. And I think if we compare it to the GFC, which was the most recent crisis that we can compare it to, dividends fell from peak to trough during the financial crisis globally by around 30%. But that happened over a 15 to 18 month period. We've seen these falls happening literally in the last 2 to 3 months. So it's been a very rapid and abrupt cessation of payments, basically.
The items in the report suggest that North American dividends are likely to be less affected than Europe and the UK. Can I just quiz you about that? Because what we've seen, even strong companies at some point turning to government assistance programs, we know that this crisis is going to go on for much longer than many anticipate, which suggests that tapping liquidity provisions, may be turning to government for assistance on when it comes to workers as well. Why do you think the US is any better positioned than the rest of the world?
It's really about the fact that the makeup of the market is quite different in the US to other parts of the world. The US isn't a particularly high yielding dividend market. It only yields around 2%. And also they have had a propensity to do more share buybacks. They've returned a lot of cash to shareholders via share buybacks. So what we're seeing at the margin is actually the share buybacks being turned off and some of the dividends being kept. Now, it's very stock specific. Dividends will fall in the US, but they just won't fall as much as, say, areas such as UK or Europe.
Jane, very good morning to you. Has your portfolio become a lot more dangerous because you have to transfer money from stocks which are not now paying an income to stocks that you think the income is more reliable? Hence, you have a smaller pool of stocks that you're looking at. And as such, of course, when those individual stocks move, because there's not so many of them, it actually creates a bit more volatility in your portfolio.
I don't think it's more dangerous. I think that definitely we have shifted the portfolio to go towards the companies we think will be more resilient. This is a very challenging environment. No one has any look into what the future is going to really be. So it's very natural for boards and for senior management to hunker down and save cash. With regards to our portfolios, there are still plenty of companies that are, however, paying dividends. In our index in 2019, around 40% of those payments were from companies that we think are relatively defensive in this environment: healthcare, consumer staples, utilities, technology as well. And so we can still find plenty of opportunities in companies that we think will weather this as well as they can.